And what if I told you after 6 years in the market and testing hundreds of strategies, I found 2 simple trading models that consistently work? And no, this isn't luck. I have a 68% win rate with these 2 models, and I trade live in front of hundreds of Playbit members every single day. And they're able to use these exact same models to extract money from the markets alongside me in real time. So if you're watching this video, no more guesswork, no more breaking even, no more stress. I personally trade these 2 models on Nasdaq futures during the first few hours of the New York AM session, and I also apply them to crypto. But if you trade other markets such as gold, stocks, options, you can also apply these strategies. This isn't one of those videos where a guru will just yap at you. No, I'm actually going to screen share the exact strategies and show you live examples of me trading them so you can copy me and start winning today. But before I break down these strategies, let me expose the biggest mistakes keeping most traders from becoming profitable, and that's overcomplicating trading. They clutter their charts with too many indicators, they hesitate and second guess themselves instead of executing, they think more complex strategies equals higher win rates and more profitability, and this couldn't be further from the truth. The reality is, simplicity is best. Even after 6 years of trading, I still keep my strategies as simple as humanly possible, and I can explain my entire approach in under 30 seconds. If your charts look like a coloring book, you're doing it all wrong. The best traders have a repeatable, mechanical strategy with clear entry and exit models. Both of these models I'm about to share with you today are easy and simplistic, and all you need to do is execute them every time the opportunities present themselves. I'm about to show you how to live in this video, so let's dive into the charts. So there are 2 trading strategies that I trade, the ILM, which you can see on the screen right now, and also the ORB. So the ILM is designed to catch reversals, and the ORB is designed to trade momentum and continuations. So for the sake of this video, I'm going to be demonstrating on the micro NQ futures charts, as that's what you should be trading if you're a beginner or intermediate and not risking too much. So let's start with strategy 1, the ILM. So ILM stands for inverted liquidity model. It's a strategic approach to trading focused on the use of fair value gaps and the dynamics of buy side and sell side liquidity during range bound markets. It aims to identify optimal entry and exit points based on the interactions between liquidity imbalances and price inefficiencies. So take a screenshot of these notes so you've got them for your own records whilst I explain them. This strategy works on multiple time frames, but as I'm day trading, I want to be done with my session in just a few hours so that I can enjoy the freedom and the rest of my day, which is why we trade. So I usually trade this on M5, M3 and M1. Just keep in mind that M5 and M3 are higher probability setups, but you can get in earlier on the M1, but it is a little bit more risky. So at its core, the model waits for major levels of liquidity to be swept, triggered by a cluster of buy or sell orders, and this is signaled by the creation of a fair value gap. Then we're looking for a failure and invalidation of the fair value gap to suggest that the previous inefficiency has been addressed by the market, and that's our entry model. Once liquidity has been swept and the fair value gap has failed, entries are taken at CMP at a candle body close above or below, or on the retest of the inverted fair value gap as we anticipate a change in state of delivery. Once this populates, we anticipate a reversal in price movement, and then we target the opposite side of liquidity. It's very simple. So when it comes to placing your stop loss, place it at the candle close above or below the inverted fair value gap for a more aggressive approach, or above or below the swing high or swing low of the liquidity sweep for a more conservative approach. So as I want to make this as beginner friendly as possible, I'll be explaining this in the context of major liquidity and time-based liquidity levels. The ILM also works with internal liquidity, but for higher probability and easier to follow setups, I suggest sticking to these levels to begin with. So here's one trade example from my journal on the actual charts. So remember how I said I trade this model at the New York market open, and when I say New York market open, I mean New York Stock Exchange, because it's the Nasdaq, it's an indice, right? So this means at 2:15 p.m. UK time, which is GMT, I'm at my desk at my trading station ready to trade, and this is the outcome of one of the trades using this precise setup. So I'll talk you through it quickly now when you can actually see the full setup, but then I'll go back and actually use the replay tool so you can see it play out in real time. But if you remember, I described to you this is based on time-based liquidity. So as you can see, I've got my Asia low, my London low, and my London high marked, and I've also got my fair value gap marked. This is an M1 FVG, but I'm currently on M5 just for this example, but we'll actually dive into M1 when we do replay the trade. So as you can see, this is very, very simple. We've got London low liquidity has been swept, but we have no creation of a fair value gap, so this is no longer an area of interest to me. And then we have Asia low, which is swept, and then we do have the formation of an M1 FVG, which I'll show you right here. So as you can see, we've got the M1 FVG formation here. We continue to the downside a little bit, and then we get the reversal in price, and we actually invert the FVG, making this an inverted fair value gap, which is marked by IFVG. And then we take a position at the candle close above, which is here, as we can see. And then we target the opposite side of liquidity, in this case, London high. And as you can see, this position played out very well. So I'm going to go back and use the replay tool and show you how you can actually execute this strategy exactly like I do. And all you have to do is show up and literally follow the steps that I'm about to lay out for you. So before I do that, I just need to clear up my chart and use the replay tool. So as you can see, we're at the desk 15 minutes before New York market open. And what I need to do now is mark my time-based levels of liquidity. Now, to make this easier for you, you can use the market session indicator. So I'm going to do this on the M5 just so we got less noise rather than the M1, but we're actually going to look to take the entry on the M1. So first thing you need to do is mark time-based liquidity that hasn't been taken yet. So in this case, I like to start at the top. Asia high, already been taken. So we're not going to mark that, but we're going to mark Asia low, and we're going to label it Asia low. Then I'm going to look at London high because it hasn't been taken yet, London high. Then I'll mark the current New York high. Obviously, New York and London are still running, but we just want to have more information if we can. We'll call that London, New York high. And essentially, that's what we're going to do. Sometimes you might need previous day low, which would be down here, previous day high. But in this case, we're not going to need that. So once I've got my levels marked out, then I'm going to go ahead and drop down to M1 because that's when, in this case, we'll be looking for an entry. Usually I've got multiple screens and I'll have M1, M3 and M5 so I can monitor everything at the same time. So essentially what we're looking for and what's going to create an area of interest for us, we're looking for one of these levels of liquidity to be taken, and we're also looking for a creation of a fair value gap at the same time. After the formation of a fair value gap, after the liquidity level has been swept, we're looking for a reversal in price action and looking for that fair value gap to fail, being inverted and indicating us that there will be a change in state of delivery. So let's zoom in a little bit and then start fast forwarding and see what happens slowly. So until we have price action cross a level or take out a level of liquidity, is not of interest to me yet. But here we go, as we can see on the M1, we've taken levels of liquidity and we've also had the formation of a fair value gap here. So we go ahead and mark that as fair value gap. And what we want to see is a reversal in price action and a candle close above the fair value gap to officially make it failed and inverted. This doesn't always happen, and sometimes we will get a continuation to the downside, but our entry model will only be on a candle close of the inversion of the fair value gap. So let's go ahead and keep going forward and see what happens. Slowly. Here we go. So there's no inversion of the fair value gap. However, we have a formation of another fair value gap here, which is a significant area of interest to me. So then we go and mark that as fair value gap. So it looks like this candle could close above, but we're not sure yet. So let's go ahead and continue seeing what happens. So price continuation to the downside before rejection. Okay, here we go. So now our entry model has presented itself. So we have a inverted fair value gap. We can go ahead and mark this as IFVG now because it's failed. And do you remember how I said that we take our entry at this successful candle close or an inversion of the fair value gap? So here we'd go ahead and take our long position and we'd set our stop loss at the candle close below the inverted fair value gap for an aggressive approach, or if we wanted to be slightly more conservative with our risk, we would set it below the swing low. In this case, I placed it below the candle close of the inverted fair value gap, and then we go ahead and target the opposite side of time-based liquidity in this case. So there you go. I just want to say here that there is also the option of setting multiple take profit targets to be a bit more conservative with the risk. So you could just go ahead and mark out other levels of internal liquidity, for example, here and here, if you wish to. And then we go ahead and continue to see what happens. So we play. And there you go. That would be the full trade position in this example. Extremely simple, extremely effective. And this plays out over and over again. Now, to show you what this looks like in the context of a short, I'm going to go over a more recent trade position. I'm not going to do the replay and show you the whole thing. I'm just going to talk you through it, how it played out. And this was on Thursday, the 20th of February, 2025, again, taken in front of the entire playbook community. So as we can see here, if we go back to the market sessions, we can see that we've got our major levels of liquidity marked out. We've got Asia high, Asia low, and in this case we have previous day low as well. And we also marked out London high, which was the liquidity level that was swept, which gave us the area of interest. So this trade was actually taken on the M3. So I'm going to go back and just tell you how it played out. So we had all of our liquidity levels marked out, and we had the formation of an M3 fair value gap, which then proceeded to take out London high. This means that this fair value gap became the area of interest. So then we were looking for a candle close inversion or a retest to trigger our entry model. And you can see in this case, we had had M3 FEG, London highs swept, candle closed below, retest where the entry, and then we target previous day low. And you can see this gave me a nice 3.5 hour trade. So after you learn this model, the next thing that I'm going to tell you to do is make sure you journal your trades. So as you can see, here's my trade journal, and I just want to show you that my ILM win rate is 70%, and over the last 6 months since September, I've collected a total of 54.5 using the ILM model. So it is powerful, it does work, you just need to learn how to execute it properly. So with that said, I just want to remind you that no strategy wins 100% of the time, including this one. As you can see, my win rate with this one is around 70%. So a good model is just about having a favorable win rate and a favorable risk reward ratio. So with the ILM, because you're trading reversals, you tend to have a very high risk reward ratio, and this is what makes you profitable over time. So moving on to the next strategy, the ORB. So the ORB stands for opening range break, and this strategy's approach is based on identifying and defining the market's opening range on the M15, and you combine this with Fibonacci levels as a standard deviation to achieve a simple yet robust model. This is by far the most easy and the most mechanical trading model I've ever come across. Even a dog could trade it, but at the same time, it's also one of the most powerful and effective. The R collected with the ORB is less than ILM, as we are trading continuations rather than reversals. So be sure if you implement this strategy, you take your profits aggressively. So before we get into the strategy, you need to configure your fib settings to match mine so you have standard deviations, and this will make sense why in a minute. So take a screenshot of this over here so that you know how to set your fib settings. So again, let's dive into a previous trade. I'm going to explain how I implemented the strategy, the rationale, and how you can take it too. So this was an ORB trade taken on Wednesday the 29th of October 2024. It was a great example. This is a trade that I have in my journal. Because I have this data, I'm able to go back and find good examples for you guys. So here we go. What we need to do first is identify the opening range. So how we do this is we go to the M15 candle and we mark the high and the low of that range. So here we can see 15 minutes after market open, we want to mark that range. So after we've identified our range on the M15, it's so easy. Like I said, just mark your high and low of the candle. For me, it's at 2:45 p.m. That's 15 minutes after the market open. We then drop down to the M5, and what we're looking for is a full candle closure outside of this range to take an entry. So as you can see, full candle closure took the entry, and then what we need to do is go ahead and pull up our Fibonacci retracement tool with the settings that I've showed you, so you have standard deviations. And in a long position, you want to drag from low to high, and that will be your standard deviations. So you go ahead and draw your fib tool from low to high from a long position, or high to low from a short position, and this gives you this, which we call standard deviations. So all you need to do is set your stop loss at a 0.5 standard deviation, and then you set your TP at 1.5 or 2 standard deviations, and this is a model that just plays out time and time again. What you can also do, you can trail your stop loss. So rather than just setting a hard stop at 1.5 or 2, this is a extremely simple and mechanical model. So what I'm going to do now is clear up my chart. I'm going to use the replay tool so that I can show you in real time so that you can implement this for yourself today. So remember, I told you I always get to my desk 15 minutes before New York market open. So as you can see at the bottom of the screen, 2:15 for me. Then I would go ahead and I usually would mark up my areas of liquidity, because you don't know whether it's going to be an ILM day or an ORB day. So essentially, because we have one strategy that trades reversals and one strategy that trades continuations, we mark out all levels until the market tells us what kind of day it's going to be. So in this example, I'm not going to do it in the essence of time, but as you can see, we've got market open in 15 minutes. So let's see what happens. 1 candle, 2 candle. So to identify the opening range, we need to mark the high and the low of the first 15-minute candle close after market open. So for me, this would be the 14:45 candle. We'd go ahead and mark that with a high, and then also copy that and make it into a low. And then I would go ahead and I would mark it ORB high, and I would go ahead and I would mark the low ORB low. And then we're watching and waiting for a full M5 candle closure outside of the range to trigger our entry. So let's have a look. There we go. We can see a full M5 candle closure. So what I would go and do, I would go ahead and take a long at CMP, as I showed you before. And then remember the fib settings. Because we are in a long position, I would go and pull my fib from range low to range high. I would then go ahead and set my stop loss at the 0.5 standard deviation, and I would go ahead and set my take profit at the 1.5 or 2, depending on the sentiment for the day. And then that would be it. We go ahead and see what happens, and then we go ahead and get there. And like I said, you can trail your stop loss if you wish to be be slightly more aggressive and not have a hard take profit. But nonetheless, this trade collected 2.77 R for me, which is happy days. Then we go ahead and stick it in our journal as always. As you can see, this strategy has a 67% win rate for me with a total of 20.5 R collected since September 2024. So the only other thing you need to be aware of when trading the ORB is how to identify bad days. In the case that the ORB range is not broken within the first 2.5 hours of the trading session, you might as well skip the day, as price is most likely to continue raising, and without continuation or momentum, our trade becomes very low probability. And just for your reference, this is what the ORB looks like in the context of a short. Same concept, range high, range low, fib level pull for standard deviations, stop loss at 0.5, take profit at 2. Again, it plays out over and over again. And as you see, for me, it's got a 67% win rate. So I hope you can learn and apply these strategies, and I hope that it helps you make money from the market. Final thing that I would like to say is that there are additional confluences that we can add to these models. So for the ILM, to increase probability, we can look at SMT, higher time frame analysis, we can look at using Playbit's EMA indicator, etc. But for the sake of this video, I wanted to keep it beginner friendly, so we'll touch on that in another video, so make sure you subscribe. Again, please remember that no strategy has a 100% win rate, but trading isn't about being right every single time. It's about controlling risk and maximizing reward. With the ILM, you're trading with liquidity, taking advantage of sweeps and reversals. With the ORB, you're letting the momentum do the heavy lifting and trading continuations. Both strategies are extremely mechanical, repeatable, and they don't require any guessing. I only take A+ setups that fit these models, and having models that catch both reversals and momentum continuations allow me to identify at least one of these setups daily, and that's why I'm able to capitalize and consistently make 6 figures per month day trading. So if you want to master these two strategies, I've left free ebooks and full video tutorials in the description that breaks them down step by step for you. If you're serious about trading and want to learn and apply them directly with me and my team, check out Playbit. You'll get real-time trading live streams and exclusive coaching. I personally trade these strategies live in front of my community every single day. It's not just me making money, it's the hundreds and thousands of Playbit members executing these setups to profit daily as well. If you've made it this far, you now have 2 trading models that can make you consistent money if you're able to apply them properly. Most traders never escape the break-even phase because they overcomplicate things and they refuse to stick to simplicity. After watching this video, this is no longer going to be you. Once you've proven to yourself that you can be consistently profitable and extract money from the markets, all you need to do is scale your capital and size, not change your models and strategies. Prove to yourself that you can turn 100 into 1000. Then you would have built the confidence and skills to turn 1000 into 10,000, 10,000 into 100,000, and 100,000 into 1,000,000, and so on. Start with education, start small, and only attempt to scale from there. You now have 2 proven strategies, so the only question is, are you going to use them or stay stuck like 99% of traders? The choice is yours, and I'll see you in the next video.